You're listening to the voice of the private sector. Welcome to Brian Bushlach's Business Briefing, only on FM News 101.
Okay, let's roll up our sleeves and get right down to business. If you're traveling this summer, stay with us. Big news from Delta Airlines and Mike Medeiros. We'll also have clarification on the controversial Vancouver Energy Project and big news for those of you looking to take your marketing to the next level. First, though, let's start with real estate. The market is red hot, but we're finding there's confusion about the popular 1031 exchange. So we call on our expert, Michael Lortz at Geffen Mesher.
You're absolutely right, Brian. In fact, I think 1031 exchange is probably something everybody in real estate has heard of at one time or another, but when it comes to executing it properly, people can get it wrong. And one of the main things they can get wrong is they might sell a piece of property and then come to me and say, okay, Michael, now I want to do a 1031 exchange. And in most situations, it's now too late.
And that's because you have some timelines here. And with the market as hot as it is, I mean, that's great if you sell your property, but you also have to find one. Let's walk through that process.
Sure. So the first thing they've got to do before they sell their property, they have to work with a qualified intermediary, oftentimes called an accommodator. And there are folks in town that do this. This is a stable industry. You want to go with somebody reputable that's got good insurance because there have been instances of fraud in the past. But you do have to work with the accommodator. You got to transfer your property to the accommodator who sells it, and then the money sits in a bank account that the accommodator is managing. And then you have to direct that accommodator what to do with that money. So you've got 45 days to identify replacement properties, and you've also got 180 days to actually close on purchasing those replacement properties.
180 days. To a lot of people in our audience, sounds like a long time, but it's not.
That's not very much at all. In fact, generally, and this is a hot real estate market, so general rules don't always apply, but generally speaking, you want to be looking for your replacement properties well before you sell yours. And that way you've already got some things lined up. Hopefully you've already got a detailed plan as to what you want to buy.
Let's talk about rule of thumb, Michael, in terms of trading up and deferring the gain. I know that there's a lot of misconception when it comes to this.
Yes. So the rule of thumb that you hear a lot is, well, trade up. So what that means is if you're going to sell a property for, say, $10 million, then you need to buy replacement properties of at least $10 million in order to defer all of the gain and not pay taxes. But that's just a rule of thumb. It's not always true. In fact, that's where I find a lot of mistakes. Owners apply that rule of thumb without understanding some other concepts like boot.
What is boot? Because I've talked to a financial advisor that I trust. He kind of walked me through it a little bit, but why don't you give us a good description of what that means?
Yeah, boot is generally one of two things. Either the owner is pulling cash out, so they sell a property, they buy replacement properties, but they still walk away with some cash, or they're reducing their debt load. So maybe they sell a building, they buy other buildings, but at the end of the day, they now owe less money on the buildings than they did previously. Those two things generally result in boot, and that boot is what can trigger taxable gain.
Okay, let's talk about a transaction. Can you walk us through one? Because I know that will help our audience kind of get our head around this process.
Absolutely. Well, I know that the radio audience loves numbers, at least if they're number nerds like myself. So let me just throw a couple of numbers at you. So let's talk about a recent transaction. Had a client that had an apartment complex. They sold it for about $10 million. The apartment complex had a basis of $3 million. So if they did not do an exchange, that means there'd be a taxable gain of $7 million. However, they did want to do an exchange, and they had identified a warehouse cost $12 million that they wanted to exchange into. They were going to finance it 50%, so $6 million of the sale was going to roll into that warehouse, and then $6 million of debt. I should have mentioned that the apartment complex was paid for, so there was no debt to pay off. Yeah. All right, so they're trading up from $10 million to $12 million. So the rule of thumb would say, oh, that's great, no taxable gain. But that's where there's a problem, because $10 million of cash on the sale, only investing $6 million of it into the warehouse, because you're also doing $6 million of debt, owner's going to walk away with $4 million of cash. That means some of the gain, some of that $7 million gain will be taxable. Now, the big question is, how much? And this is where I find a lot of owners make a mistake. What they do is they say to me, well, Michael, I've got $4 million of cash out of this deal, and my basis in the complex was $3 million, so I have a $1 million gain. And you know, Michael, I hate paying taxes, but hey, if I can only pay taxes on $1 million and I get $4 million of cash, you know, I can take some of my risk off the table. This is a good thing for me, so I'm going to do the 1031 exchange. And I say, whoa, hold up there. There's a rule that matters here, and the rule is that if you have boot, and again, the $4 million of cash is boot, then that means you've got to recognize gain dollar for dollar equal to the boot up until you recognize all of the gain. So if there's $4 million of boot and the total gain here was $7 million, then that means you're going to have to recognize $4 million of gain. Every dollar of boot equals $1 a gain in this transaction. So yes, you're going to do a 1031 exchange. It'll still save you money, because instead of paying taxes on $7 million, you're paying taxes on only $4 million now. So it was helpful, but you're paying tax on $4 million, not $1 million.
Okay, I'm going to give out your email too, because I know our listeners, particularly our real estate investors, are hearing that and pulling off the side of the road maybe. Lortz, Lortz, at gmco.com. Michael can actually walk and talk you through that via email or on the phone. Old-fashioned phone calls work as well, but get in touch with him if you want to walk through that, because I think that's something that obviously a lot of owners aren't aware of. And there's a couple other things to watch out for too, right?
Yeah, so 1031 exchanges can be simple or complex, and that's one of the beauties of 1031 exchanges. You can use them to accomplish multiple goals. What I just described was sort of a traditional forward exchange, but there's also reverse exchanges where you actually buy the replacement property first and then sell the property that you already owned. And that works as well. Okay. More complicated, of course, because somehow you got to come up with the money to buy the replacement property without selling the other property first. There's also something we call an improvement exchange. Some clients want to actually make improvements on property, perhaps build a building that doesn't currently exist, and that will be the replacement property. So there's lots of different complexities to exchanges, and what I would really encourage the radio audience is to talk to your tax advisor before you execute any portion of the exchange. Before you sell the property, before you buy the property, have your tax professional model the tax results, because in a recent case for me, it really changed the strategy of my client. They had to go out and look for very different replacement property than they were originally expecting to find.
Last question for you. You are in touch with a lot of people in this market and across the Northwest. This commercial real estate cycle, if it's a baseball game, what inning are we in, Michael?
Well, this will be a guess on my part, but it's starting to feel to me like we're closer to inning 7. I'm starting to hear a few rumblings about things slowing down. There's a lot of projects that are in the works, and that's going to keep things going for a while. And there's a lot of national players that are here in the Northwest buying properties. But the local folks seem to be slowing down a bit in terms of new projects under development. I'm hearing that some of the architects are starting to slow down in terms of the amount of design they have in the works. So I think we're starting to get there. 7th inning stretch sounds good to me.
Well, great to get a read on the market from Michael Lortz at Geffen Mesher. Again, his email, MLORTZ@gmco.com. Up next, if you're traveling, big news from Delta Airlines.